Hi guys, Max here, and today is your daily market update for yesterday, Tuesday, the 7th of June. So how was it? Well, actually, equities did a little bit well. As you can see, it's green for the most part. You can't see the energy sector here, but it is pretty damn strong. Most energy stocks were up by 3, 4, or even 5% for the day because energy prices have risen and they've stayed high, and actually they rose again yesterday as well. Most other sectors did decently as a whole. Tech was quite strong, as you can see. Big tech was fine. Financials were quite strong. Real estate was strong. Industrials was strong. Healthcare was strong. The only parts which didn't really do too well were consumer cyclicals and consumer defensives. Basically, companies which sell lots of products. Think Amazon, think Walmart, think Target again. Target had another poor day, falling by another 2%. And really, that's just because inflation is eating away into people's earnings, and so they're spending less money at shops, and these are basically shops for the most part. Now, the S&P 500 on the whole rose by about 0.9%, with the Nasdaq rising also 0.9%, pretty much on par. The Dow Jones rose just by a touch less at 0.8%, and then the Russell 2000 actually had really quite a strong day and rose by about 1.6%, which is a little bit unusual, to be honest. Now, as for the rest of the world, it was actually okay as well. Nothing ridiculously special. The British markets, the FTSE 100 actually fell by about 0.2%, and the Stoxx 600 fell by about 0.3%. I know it looks very green there, but that's just because, unfortunately, I took this screenshot of this heat map this morning when European markets had already opened, and so far today, stocks are doing a lot better. So for the most part, other equities around the world did okay, but nothing ridiculously well. On the whole then, the MSCI World Index rose by about 0.4%. Now, the dollar really didn't see much of a change at all. The euro rose by something tiny, like 0.1%. It's still sitting at about $1.07. The pound is still sitting at about $1.26, which are numbers we've gotten very used to recently. As for the fixed income asset market, then bonds, what did we see there? Well, we saw a slight decrease in yields across the board. The US 10-year Treasury yield fell by about 6 basis points and is now just below 3% at 2.98%. The German and British 10-year yields also fell, but only by about 3 basis points. So no major shifts, but just slight inflows into asset markets. Commodity prices then, well, here it isn't too good. Oil prices rose for the most part. WTI crude oil rose by another 1%. Right now, it's sitting at $120 a barrel. Brent crude is sitting even higher at $121 a barrel. Really, oil prices are crazy high right now, and the dangerous thing about this is, unlike that spike we saw I think almost 4 months ago now when the war in Ukraine started, this price action isn't due to some panic amongst speculators and investors like we saw back then. This is due to real market forces, real buying pressure and real selling pressure from demand and supply, as opposed to speculators driving up the price of oil. And so high oil prices like this are actually really quite worrying. Gold is still sitting around that $1,850 mark, no major changes there. And then in the crypto market, well, it was a decent day, making up for about half of the losses that we saw the day before. Bitcoin is back above $30,000, as you can see. Ethereum is back above $1,800, though only just. Most altcoins rose by something like 2 to 3% for the day. A little bit strong, but nothing major. Crypto moving in line with other risk on assets, in line with US and American equities, as you can see, so nothing too major to report on. Regarding crypto market news that's come out recently, well, there was that Reuters article which I covered in its full in-depth video on its own yesterday. If you haven't seen it, go check it out. Basically, Reuters is accusing Binance of being complicit in laundering money and helping fraudsters get away, scams get away, helping drug money move across borders and all sorts of things like that. I do a full analysis of what Reuters is alleging and then Binance's retort to all of that. In short, I think the article is a little bit unfounded and a little bit aggressive and has some dodgy things in there, like Reuters attacks privacy and the idea of having private transactions, which I don't think there's anything wrong with. If you want that, then go check out the rest of that video. It will be down below in the link in the description. For the most part then, stocks and risk on assets were up, and why is that? Well, it's not really too clear. This might be due to some optimism amongst traders and investors ahead of the CPI data report that we get out on Friday regarding the United States. There's this idea going around that we've reached peak inflation, that the economy is still strong and that inflation is going to really start bringing itself down. And so investors are getting a little bit excited for that. But personally, I do think they're getting ahead of themselves. The news that we're getting really isn't too positive. It's just that the markets are reacting rather positively to that negative news often. Now, what is some of that negative news that I'm talking about? Well, you can see right here, we had two pieces come out yesterday. The first from Janet Yellen and the second from the World Bank, and neither of them are good. Now, the first one is that Yellen is expecting inflation to stay very high for a long time. She doesn't really go into detail, but we can kind of read between the lines and see that she's expecting inflation to stay well above 5% for a year minimum. Personally, I think it's going to be likely worse than that. What did she literally say? Well, she said that I do expect inflation to remain high, although I very much hope that it will be coming down. And then she also mentions that the Biden administration have a forecast for average inflation over 2022 of 4.7%, and that's likely going to be very, very low. It's not going to be that low. Inflation will be far higher than Biden's forecast. Coming from the World Bank then, we see that they have cut their economic growth forecast for the world down from 4.1% to 2.9% for 2022. And to be honest, we're likely to see further cuts to that forecast as well. Now, they're citing the usual things: high inflation, the war in Ukraine, and this sort of COVID overhang effect, the supply chain crisis, everything that you can imagine. And in short, the World Bank is right. Growth is slowing in almost every country. Almost every country is likely to enter a recession over the next year. Now, the real reason that this is such a major problem is that fighting inflation and fighting low growth really doesn't go hand in hand. If there's too high inflation, you really want to bring down economic growth. You want to stop people from spending. You want to raise interest rates so that people can't spend as much money, so that they can't afford to go overdraft their bank account to go and get another credit card or to get an expensive car loan. You want to tame people's expectations and really slow the economy down. Obviously, if you're seeing slow economic growth, your intention is to do the opposite, to speed the economy up. So you cut interest rates, you make it easier to get debt, you try and encourage people getting credit cards and spending money frivolously, all in an attempt to get the economy churning, to get wages rising and things like that. Now, obviously, we are expecting both of those things to come at the same time. High inflation, which we already have, and economic stagnation, which we're starting to see now, which tells the tale for 1970s style stagflation, which is one of the things the World Bank is predicting as well. And this is really, really scary. In short, it's scary because we don't really know how to fight it. There isn't a textbook for how to improve the economy like there is when we have a recession. Stagflation is actually really quite unusual. It isn't a common phenomenon at all. The major time we've seen it is during the 1970s. And back then, before that actually happened, people thought it was impossible. They didn't even think it was worth thinking about because it could never, ever happen. And so we saw it then. It devastated our countries for over a decade, and now there are many fears that we're about to see the exact same thing happen today. And in short, no one has really a fixed answer in how to solve this crisis. Now, yesterday we did get a report regarding US consumer credit, and the level of credit in the American economy surged far higher than analysts were expecting, and that's after we saw a record high jump the month prior as well. Now, this is sort of another problem that's similar to stagflation. Actually, high credit use is kind of good for the economy. It means that people are spending lots of money, and that debt goes around multiple times, and it stimulates people's jobs and businesses, and it helps to make us all a little bit wealthier. But that's a bad thing right now when we're trying to tame inflation, because inflation is far too high. So people spending more money and increasing buying pressure is going to cause prices to rise even further. As a result, this kind of news would be okay in a normal economic cycle, but we're not in that normal economic cycle. This is bad for people right now, and it's also going to be bad for people when a recession comes around. People have more debt, interest rates are going to be rising, and so people's payments to get rid of that debt are going to be increasing as well. And this is going to be very bad for people when a recession comes and mass layoffs start to appear. It's also worth noting that right now, the savings rate amongst Americans is the lowest it's been since 2008. And 2008 is obviously quite an important year there. That was the last great financial crisis. And so this isn't a great sign either. The sort of saving grace here is that actually Americans and most other Western people as well do have relatively high levels of savings right now, thanks to the COVID pandemic, surprisingly enough. All of that economic stimulus that we had, these stimulus checks that were literally sent into your bank accounts, and then the fact that a lot of people were still working from home but not being allowed to go out and spend their money meant that people were saving a lot of money back then, and there's still the overhang of that effect, which is a little savings grace here. Now, in some corporate news, we have another scandal coming out of none other than Wells Fargo, what must be the worst bank in America. And this time it's to do with these fake interviews that have been going around in rumors for a little bit now. Basically, what was happening was Wells Fargo was conducting these sham interviews for non-white people and female people because they wanted to boost the number of people of those demographics that they were interviewing to try and make themselves look better. They never actually intended to hire these people. Oftentimes they would host these interviews for positions that had already been filled, but they just kept on piling in non-white and female people to boost their numbers. Now, in reality, this is sort of the result of government policy. Basically, Wells Fargo was afraid that their levels, their numbers that they had for hiring these people wasn't good enough, and they were scared of the US Department of Justice or someone coming around and looking into their data. So they sought to try and fix that data, and in the process, they wasted thousands of people's time. Really, though, this is one of the examples of government failure of a good policy or a policy with good intentions having a bad outcome. And it's very typical of the kind of thing you see when you actually look at how governments run. I think the best example for something like this that I've heard of in a while, and something that this is going to be a little bit of a tangent, so sorry if it's boring, but there's a policy that's present in a couple of states in the US about banning background checks for employers, so that these employers, when they need to hire someone, they aren't allowed to check or ask their interviewees whether or not they have convictions or criminal records. Now, the idea behind this is actually quite good and quite noble. It's to help criminals, people who have gone into prison, done their time, come out and they want to reintegrate into society. It's to help them find jobs because it can be really, really difficult. Now, these companies which didn't want to hire convicts, people who had been in jail or had been on the wrong side of life, well, they still didn't want to hire those people. And so what they did instead to ensure that they didn't hire people with convictions was to just flat out refuse to even consider people who were from the demographic which was most likely to have been convicted of a crime, which just so happened to be young black men. And as a result of this, unemployment of young black men in those states absolutely skyrocketed because of this failed government policy. Basically, the government didn't manage to increase the number of people who had convictions and jobs, and also somehow managed to force discrimination upon the younger black male population in these states. It was an absolute failure of government policy. It's still in place in some states now because governments are stupid, but this is just the kind of thing that we see quite often, and actually it's rather similar to what's happening in Wells Fargo. Now, we actually got a new piece of news regarding good government regulation, or what I think will probably end up being good government regulation, and it comes from none other than the European Union. I know, colour me surprised, the EU's doing something good. They've finally got their act together and sorted out this common charger for phones and a bunch of other devices so that companies like Apple can't force people to buy extra products just to run their devices. Basically, everything's going to have to use USB-C, Apple included, and this is for the most part a good idea and should help to protect consumers. Now, frankly, I do hope that this spills overseas as well. Will Apple make a specific iPhone and iPad and everything specifically for the European market and then keep using the lightning cable that they use for every other market? Maybe, but frankly, I hope not. I suspect they don't really want to split up their supply chain like that. Apple does make a lot of money from the lightning port and from selling accessories that are only compatible with Apple's products, so maybe they will go that way. Hopefully they won't. Personally, I would far rather just have everything in my house use USB-C. I'm sure you're probably the same. Now, another new development from Apple is that they are going to be entering the buy now, pay later sector with something called Apple Pay Later. This does make perfect sense. It's a great idea from Apple's business point of view. They've already got their Apple Pay systems. This will work in tangent with that. And it's basically, for those of you who don't know, it's just a way to finance purchases over a few weeks or a couple of months with zero interest. Over the last decade or so, we've seen an absolutely monumental growth of buy now, pay later systems. The biggest one that I can think of is probably Klarna, which is mega successful. But actually, Apple is really going to have a really easy time infiltrating this market. They're going to have their systems built into almost every phone in the Western world. So I doubt they'll struggle at all when it comes to actually breaking into this industry. Now, this doesn't mean that the sector is without controversy, though. Buy now, pay later has been called predatory, and it's got a lot of criticism from an awful lot of different people because it preys on people's desire to have the newest and the latest thing, even when they can't afford it. There have been examples of people financing a pizza purchase. Yes, a $30 pizza. You split it into 4 payments over 4 weeks of, $7.50. And frankly, if buy now, pay later is just used on 1 or 2 occasions, then it really isn't much of a problem. But the problem arises when people use it for everything and suddenly they find themselves incapable of affording what they're buying. Now, personally, I am a little bit torn on this whole issue. I do believe in personal responsibility. I believe that if someone takes out a credit card and they're given $10,000 worth of credit, and if they spend it all and they can't pay it back, well, guess what? That was a poor decision on your behalf, and that's your fault. I personally believe that when it comes to things that are essential purchases, then actually I do have some sympathy regarding this. But with people who just have an inability to budget and they just spend all the money they have and the money they don't have as well, well, I really don't quite get why it's so controversial. Here in the UK, we had a similar controversy over the last decade with payday loans, which were short-term loans, which had monumental APR rates because they got around government policy using things like fees instead of interest rates. In short, it's a very hot topic and everyone seems to hate these companies. But frankly, I do think the vitriol is all a little bit overstated. And at some point, you have to just admit that personal responsibility is a real thing. I also struggle to see the distinction between credit cards and other loan systems that we already have, and then this new buy now, pay later system. I don't really get why it's the target of such huge criticism when a credit card essentially achieves the exact same thing. People make the argument that these buy now, pay later systems are easier to use and so easier to fall into that sort of trap. But frankly, I don't think they're any harder to use than credit cards themselves. Maybe this is something to do with big banks and their lobbying schemes and the fact that these companies are newer and probably don't have that same sort of influence regarding lawmakers and media organizations. To be honest, I'm not really sure where this comes from. Finally, then, we just have a little bit to talk about Elon because for once, actually, he's talking about something very, very relevant to this channel and to my business, Stoic Media. He's talking about spam and scam ads on YouTube, and he's basically picked a new target. And this is what he's decided to rally against over the last day or so. As you can see, he tweeted this: YouTube seems to be non-stop scam ads, which is 100% true. It's a massive problem, and actually, it's a massive problem in far more than just the ads that are used. If you've ever been down to my comment section, you'll see that there are a myriad of different bots posting scripts trying to get you to go and find a trader to try and make you loads of money. They're 100% scams. Obviously, never contact those people, never click on any links. Actually, I think all links are automatically banned in my comment section anyway. So if you post a link, sorry, but your comment's going to be automatically deleted to try and protect people from these sorts of scams. It's actually got to the point where I pay for independent software to try and clean out my comment section, and even then it isn't good enough. Right now I'm paying about $200 a month to a company which is supposed to be clearing up the comment section. It isn't ideal, but it is far better than it used to be. Anyway, Elon has recently spoken out about it, and so suddenly everyone else is talking about it as well. And there are those saying that actually it's a really difficult problem to solve. It isn't quite as simple as people like Elon are making out. But those people seem to conveniently forget that actually YouTube profits from these scam ads more so than from their normal ads. It increases the buying pressure. If you don't know, YouTube AdSense works on an auction-based system. So when there's another entrant to that market, when there's a scam company that's paying for those ads, well, YouTube makes even more money. And so frankly, I have a lot of doubts about whether or not YouTube even want to help remove these scam ads. Now, Elon being Elon, he's resorted to posting memes about it. This one's rather relevant and a little bit funny. YouTube when someone swears, YouTube when there are obvious scam ads all over their site. Their priorities seem to be perfectly clear. They prioritize AdSense revenue above all else. When someone swears in a video, it gets detected by some software and that gets flagged to potential advertisers, and it massively cuts down the people who are willing to advertise on your videos, which means the ad rates fall, and so YouTube makes less money. It makes sense then that they prioritize that sort of thing, that they ensure that advertisers are happy while simultaneously completely ignoring this massive black market site of scam ads that are absolutely everywhere. Personally, I pay for YouTube Premium, so I'm lucky enough to not actually see them for the most part. I'm amazed that Elon Musk doesn't pay for YouTube Premium. I don't understand why. If you watch YouTube videos and you're worth $200 billion, cough up the $10 a month. It's really not that big a deal. For the vast majority of people though, that $10 a month isn't really worth it unless you spend all day on YouTube like I do as a YouTuber. Then frankly, I don't see the value there either. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.